Hello, everyone. Welcome to another QuantInsti webinar. This is your host, Kshitij Maurya. And topic of today's webinar is applications of machine learning in options trading. Now, those of you who regularly attend our webinars may have attended a recent webinar we conducted on machine learning in options trading. Now, this is a follow-up session of that only. And in this webinar, we are going to talk about the practical aspects of machine learning in options trading. So previously we discussed about theory and the concept, and here we'll see what are the applications of the same. Now, this session will be conducted by Varun Kumar Puthula, who is a quantitative analyst at QuantInsti, and he is joining us from Rajamundry, Andhra Pradesh, India. Hi, Varun. Thanks for joining us today for this session.
Thanks, it is.
Quick introduction to Varun. So, Varun holds a master's degree in financial engineering. He has experience working as a trader, a global macro analyst, and also an algo trading strategist. He's currently working in the content and research team at QuantInsti as a quantitative analyst. And his contributions help in creating uh, interactive courses for our learners in the domain of algorithmic and quantitative trading. Now, before we start with today's session, please note that we will be answering all your questions at the end of the presentation, as we always do. And please make sure that you are putting your questions, your doubts in the questions panel during the session. And this session will be obviously recorded and will be available on QuantInsti's YouTube channel. And recording will also be shared through email uh, after 1 hour of this webinar. So yeah, without any further ado, let's start with today's session. Varun, the stage is yours.
Thanks, it is. Thanks for the introduction. Hi, everyone. This is Varun, and welcome to this webinar on applications of ML in options trading. So just a small note, it started to rain at my place. So in case there is an issue with the internet, please stay with us. I'll be back in a minute. And okay, let's start. So as you guys already know, for today's webinar, the prerequisites are basic options nomenclature. So you should know the basic option nomenclature like put, call, what are the names of the strategies, etc. And if you have an idea of basic option strategies, if not the complicated ones, if you know the basic ones, you can follow it without any problem. And it would be great if you have a basic idea of machine learning and also probably types of machine learning models. And if you have experience with machine learning, that is great. And keeping these in mind, today our approach would be completely practical. We don't want to focus on definitions, etc. We'll straight away dive into the practical implementation. How we go to practical implementation is by observing the notebooks that are coded in Python. So we may not code on live, or we may not run the entire notebook because machine learning algorithms takes time to run. But we will check the code, we will understand the logic, and we will see whether the code is meeting the objective we are presenting today. So before we move forward, let's understand the key points that are going to be covered today. And we're going to discuss 4 major applications of machine learning and options trading. But we'll go a bit in detail. First, we will understand what is the need for ML at this particular application. And once we realize the need, we will see how it is implemented in Python. And also, we will also discuss certain additional applications which are not quite common, but still few hedge fund uses these applications. So it's always good to keep up with the knowledge and the research in the field of quantitative finance. So we'll also go ahead and study, or at least understand what are these additional applications. And we will also end the webinar with an interactive Q&A session, so that if you have any doubts through the webinar or before attending the webinar, those questions will be answered. Before we move ahead, let's start with the poll question. So just to understand the audience, so that I can set my pace for this webinar, and I would request Sitish to launch the poll for the audience.
Yes, the question is select the option that best suits your experience. Uses machine learning for options trading or never used machine learning for options trading? It's a simple question. So far we have got 11% votes. It's around 40% now. We have crossed 50%. almost 60%. Okay, 70. So I think we'll see at 79. Let's cross 80 and then I'll pause. Okay, I'll close the poll and I'm sharing the results. Yeah. So 89% of our audience today never used machine learning for options trading.
Thank you, Siddhis. So since most of you guys have never used machine learning for options trading, so this would be a very useful session for you guys. Those who are already used ML for options trading, which are 11% of the audience, you guys can see what are all the additional applications that are in research and also in practice in the recent times. So let's move ahead. And yeah, so this is the major topic today. So let's start with the four major applications of ML in options trading. So the first application is predicting the underlying. So you can use ML to predict the price or direction of the underlying. Once you are done with your predictions, based on those predictions, you can take positions in options. So if you think about it, in general, an options trader also would do the same thing. He would study the market and try to guess or predict at what direction the market could go, probably up or down. Or he might, if he is using certain statistical techniques, he might also try to predict the price for tomorrow or the most recent future and open his options position. So we will see how ML can be used in this particular case. And yes, but the first question we need to ask is, what is the need? What is the need to use ML in this case? So the first reason is it improves your decision making because as a human, we are limited time and resources, and at the same time, you have limited data. So of course, not all strategies are same. Not everybody uses the same strategies, but everybody is limited by the data they use to take the decision to create a strategy. But with ML, there are no such limitations. You can have as much data you want, and you can improve your decision making process. And it would also improve the efficiency. So as humans, again, we might take a lot of time to strategize our analysis and also take the decisions, but with ML it is much faster, it is much cleaner as well. And this is intuitive as well. It increases the accuracy since there is no chance of human error. It increases the accuracy, and also there is a chance for you to improve your model again and again, so to reach that particular accuracy threshold. And again, this is very important reason why we are using ML in this particular application. It is to automate and scale. So not only it helps to automate your decision making processes and selecting the strategy, etc. It would also help you to scale it. So you're no longer limited to a single market or a single exchange when you're using ML. You can replicate the same strategy or the same ML model to predict the prices of underlying for any kind of asset or any kind of market you can get access to. Now that we understood why we are using ML for this particular application, let's move ahead and see how we are using it. In general, this is if you see in a top level for an ML application, there would be an input. That input will be passed to a model, an ML model, and you get an output. But depending on the output, you apply those outputs to your cases. So in our case, which is to predict the underlying. So first we are going to select the features and we're going to pass the features to an ML model. That ML model could be a classifier or a regressor, and it's going to tell us if you're using classifier, it would classify the next day's movement to be bullish or bearish. That's exactly what we want to take a decision to deploy an option strategy. And if you're using a regressor, you can also predict or you can also calculate the range for tomorrow. So in options, range is also a alpha point where you can create certain strategies that plays with the range, especially spreads, etc. But what kind of features can we use in this case? So for features, you can use past returns. Although they may not 100% predict where the market could go tomorrow, it has some predictability. So we will use past returns as one of the features. We will use RSA. We will use a bunch of technical indicators as well. Especially we will use RSA because in any day, if you have to comment on the sentiment or the direction of a stock, it is a combination of momentum, volatility, volume, and trend. So if we have some statistical or technical indicators that's going to give that information, we will use those as features to your ML model so that we can classify the next day's movement as either bullish, bearish, and we can also predict or calculate the trading range. So for that reason, we're using RSI, but it can be replaced with any kind of momentum indicator. This is just as an example. You can use ATR, average true range, just to understand the strength of the trend. And you can also use other volatility based indicators in addition to these that are mentioned on the screen. You can use Bollinger Band, which gives you a nice combination of volatility and also will give you a basic idea of where the trend is or what phase the market is. So using these fundamental ideas or fundamental features, you can give these as input to your model and help. It will basically tell you whether the market could be bullish or bearish, or it will calculate the range for you. But once these are calculated, how can you apply this is a real question. So for application, you can select these strategies. For example, you can open a bull call spread if your algorithm says tomorrow it's going to be bullish, or you can open a bear call spread depending on the classification the ML model does, or you can use bull put spread, bear put spread. You can use any option strategy if you have an idea on it. And yeah, this is the basic thought process of using machine learning to predict the underlying and apply it for taking a position in the option. But now that you got a basic idea of how this thing works, so let's go ahead and understand how this is done in Python. So we will decide, like we will take a decision tree classifier. So you can use any model and try it out, but for this example, we are going to take a decision tree classifier. And since it's a classifier, we can classify it as bullish or bearish. But for this example, if our classifier says tomorrow is going to be bullish, then we are going to open a bull call spread. So this is the idea. So we are going to give these features to the machine learning model, classify whether tomorrow would be bullish or bearish. If tomorrow model says tomorrow is going to be bullish, we will open a bull call spread. I must give a disclaimer, this is not a strategy we are recommending you to deploy. This is just an idea of how you can use machine learning. And this can be completely customizable. You can change the ML model, you can change the input features, you can also change the way you're interpreting the options strategy or interpreting the output of this model and selection of strategy as well. Now, so we have a course for it. We have a course called Machine Learning for Options Trading, which is like highly in demand. And in this course, we have created a notebook, or we've created a bunch of notebooks that deals with this particular application. So let's go ahead and let's go to the course and see how this particular case is coded in Python. So you can find the course in Contra portal if you go to courses, and the course name is Machine Learning for Options Trading. So this link will be shared at the end of the webinar. So you can just enter the course, and there are several sections which covers most of the applications of machine learning and also the techniques that you can use not only for options but also for ML and the combination as well. But there is a particular section in this course which specifically talks about this application, which is predicting the underlying price. So for example, there is this section which says forecast direction of underlying with decision tree. So first, let's understand how the features are calculated. So I'm going to open this notebook. The name of this unit is predictor and target variables. As you know, every ML algorithm has a predictor variable and target variable, which are nothing but the input and output variables. So let's see how you can create your input and output variables. And once you understand how these are created, then we can go ahead and apply machine learning on the scene and probably see a strategy also based on that. So here is a notebook, and this is how this is the complete architecture of the idea we have presented right now, or maybe the application we have presented right now. And there are 4 parts to it. So let me explain. Let me take time and explain this so that if it is clear, then you're going to follow much easier. So any kind of machine learning application, the first step is data preparation. So this is not limited to this particular case. For most of the cases, the first step is to prepare the data. So you import the data and then you define the features. For example, in this case, we have defined 4 features and like previous returns and 3 technical indicators. You can define features as per your understanding and the experience. And then the next step would be to clean the data. Basically, you clean the data so that there are no NaN values, and then define the target variable. So define features. Features means input variable and target means output variable. Now, once you have these ready, then you go to the next step, which is data pre-processing. So pre-processing is a step where you split your data into 2 data sets, where on one data set you will train your ML model so that it will learn the internal patterns and try to fit for the objective. And in the next set, you will test the particular ML model, whether it is giving you returns or not, or whether it is acting as you planned. So this is the steps that are going to take in data pre-processing. Once this is done, the next step is ML model implementation and forecasting. So as discussed earlier, we are going to use a decision tree classifier. Why are we using this? We are using this to predict the direction of underlying. So basically, this output of this classifier will tell you whether the underlying will go up or go down. And based on this, we are going to generate some trading signals, and we'll not stop here. We'll also evaluate. Like it's our job doesn't end just by generating signals. Right? We should also see how it worked or how it performed in the test period, so that we'll understand whether it can be taken live or not. So this is the structure of the notebook. As discussed earlier, we're not going to run each and every code because it's going to take a lot of time. But just to focus on the idea and the applications, let's see how the code is structured and let's understand the flow if we had to replicate the same. And yes, so this notebook is structured as follows. So first we'll just import the libraries that are required, and the important thing is to get the data, and here we are using S&P 500 options data. So for that reason, the underlying would be S&P 500 index. So the entire session will be focusing on how to trade S&P 500 options, but this is completely replicable. Like if you are from India, you can replace that with NSE options data. But just for a wider coverage, we here are presenting you with US market data. So since S&P 500 options has S&P 500 index as an underlying, we are going to import that data. So the basic OHLCV data. And next, the first step would be to define the input variables or predictor variables. So as discussed, one of the variable is past returns. So here you can see we are taking returns of multiple periods like 1 period, 5 period, 10, 22, 44, 88. So this is where this is the initial data frame we got, and we also added the input parameters. So in this way, we keep on we continue to add the input parameters to the data frame and get the input parameters ready, and also the output parameters. So the next step is to add some more features as discussed, the technical indicator. So ATR, here we calculated ATR, RSI, Bollinger Bands, etc. And as you could see, the dataset has increased. Initially, it was till the returns, till the past returns. Now the technical indicators were also added to the same dataset. So now we are ready with the input parameters. So let's visualize this. So if you had to visualize, you can visualize like this and see if there are any abnormal quantities, and you can clean the data. And so next step is to define the output variable. What do you want to be the output? As we have seen earlier, let me get that again. So our output, you want output to say whether it is bullish or not. So if the algorithm says that tomorrow is going to be bullish, that's going to be a trading signal to basically act upon with this strategy. So that's what we are going to do. So basically we define something called signal. So if the signal is 1, tomorrow is going to be bullish, and if the signal is 0, tomorrow is not going to be bullish. So you can also say it is bearish. So for example, if you see here for an extended period of time, the algorithm is saying the market is going to be bullish. So you can continue holding your positions. And once it start to drop to the bearish signal, you can close your position. So this is going to be a repeated signal. And so this is the basic idea of how to create the input and output variables in Python. And yeah, you can access this notebook if you take a free preview of the course. You can do that after the webinar when you get time. And now that we have generated input and output variables, now let's understand how we are going to input these variables to the machine learning model and calculate the signals, and also how we're going to act upon those signals. So the same structure. So let's continue where we left. So we left, we left here. So we left at the place where we have calculated these input parameters. We just imported those parameters that were calculated in the previous notebook. And see, the output parameters are also there. For example, on this particular day, the signal is 1. The output, this is called target variable. Target variable is 1. So you will take a long position on the very next day. Since on this day it is 1, you take a position on the next day. So let's see, as we discussed, once this target variable is defined, the next thing is to split the data. This is common for almost all the applications we're going to discuss today. That's why I'm reinforcing it by showing you the image. So let's see how the test and train set is defined. So we have split the data into 70%, like zero point 0.7 and 0.3. That means 70% of the data is taken as training data set, where we will make the machine learning model to learn these patterns. And on the rest of the data, we're going to test it. So the model we're going to use is decision tree classifier, and these are the input parameters like maximum depth, minimum sample leaf, and random state. So with these input parameters, we have defined the model. We named it as CLF since we are classifying. And once you define the model, next step is to fit the model to the training data. So it goes with a single line. You just call the model with dot fit, and you can fit the model by inputting the training data set. So in general, whenever you fit a model, you just want to know how the accuracy was on the training data set and how well did it learn. So here on the training data set, the accuracy is almost 60%. On the test data set, on the accuracy is almost 58%, which are pretty decent numbers because we can't expect like 80% or 90%, etc. when it comes to a time series data, and also especially in the implementation of quantitative finance. But these are pretty decent numbers. But you should also keep in mind that not every feature we add are contributing to this particular accuracy. So we are going to do something called feature importance analysis. So you can use the standard libraries to do feature importance analysis. And as you could see, this particular bar chart shows that the top features like returns on the previous day returns, and upper band and ATR. These are the features that are contributing to the accuracy, and features such as RSA are not actually contributing to the accuracy. So these are, you should understand whether your features are working or not, whether the features are actually contributing to the accuracy, and then you can actually remove these features and go ahead. You can change the model as well, since these are not contributing, these two features. And so yeah, so now with that edited one, so these are the signals. So these are the signals that are generated on the test data set. So if you have to take a position, you can act on this particular output. So let's you can also backtest this. For example, these are the signals that are generated by the ML model. Now whenever the signal is 1 on that particular day, you can open a bull call spread, and you can hold as long as the ML model says the output is 1 or the signal is 1. And as soon as it's changed to 0, you can exit the position. So that you can see in the like you can check it in the very next notebook, like how to evaluate the metrics, etc. But as of now, I'm just showing you up till here. So for example, you can actually continue and check these notebooks to understand how the returns are, how the strategy had worked, etc. So let me go to that particular section where we are going to backtest it. So the section name is options trading with decision tree classifier, where you have a code to backtest this particular strategy and understand. You can also understand how it had worked. So all these sections are a combination of notebooks and videos, so it would be easier for you to follow through. So this particular notebook name is backtesting option strategy, option spread strategy. So since we had already generated the signals, so we will just import the options data and also import the signals data. Now we will see how the signals had worked on this options data. That's the idea we have right now. So as we had already seen, these signals were generated on these particular days. So we have to set the stop loss and take profit. In general, this is a good habit to have your risk management. So we have defined 40% and 40% as stop loss and take profit with the ratio, risk reward ratio 1:1. But you can also edit these or change these. These are not standard numbers. These are just shown as a part of a demo for this particular idea and application. We have also defined a metric as day to exit before expiring. So if the contract is going to expire, you don't want to hold it. You will close your options position just a day before the expiry. So there is a process to create the data frame, create the backtester, and there are several steps to go through. But I'm going to show you the basic idea. So the basic idea is, if let's say the current position is 0, that means you're not holding any position right now, and your ML model says signal is not equal to 0. That means ML model says signal is equal to 1. So this is a scenario at which you have to open a bull call spread. So here we are writing a loop for every day. So every day these conditions are checked, and if the conditions are met, then we will open a bull call spread. So that's the basic idea. And as soon as you open, you will note down everything. You note down your trades, just like manually when you do an option trade, you maintain your trade book. So you do the same thing when you're backtesting as well. And since we are also discussed about risk management, you will define your stop loss and take profit. So depending on your entry, you can define your stop loss and take profit and continue the loop. So basically, this is a place where you're entering, and this is a place where you're exiting your position. So if the current position is not equal to zero, that means if you are holding a position, then it will check whether the exit conditions are met. If it is below the stop loss, above the take profit, or if it is at the expiry, any of these conditions are met, then you will exit your position and then note down your trades again. So this is what happens in this block of code. And let's see the output. So this is the output. So there are quite a few number of trades over the backtest period. How many are there? There are 269 trades. Let's see the first trade and understand what's happening there. So as per this, you have entered, basically this is a backtest. So you would have entered on this particular date, July 20th, and you would have bought the position for 17. So let's say $17, you would have opened that position and you held for held till 24th of the same month. Uh, the exit type is take profit. That means you gained 40%. So that's the reason you're exiting the position. So here your P&L is 9. So we keep on tracking the cumulative P&L so that we can actually understand how the trades had worked. So I'm just taking you to the next part where since we have already saved all the trade data, we use the data to analyze the strategy. So this is a strategy diagram which tells you the cumulative P&L of this particular backtest. So this is how an ML model can be used to predict the underlying and also take options positions based on the predictions. So this is a single use case. You can also change it. You can also explore how it would have worked had it predicted a bearish signal and you deployed a bearish strategy. So this is about the first application, and let's move ahead and see the very next application. So the next application is options pricing. So most of you guys know there are standard models that are being used for options pricing. But in any kind of approach, the objective is same. You would want to find the fair value of the option contract and trade accordingly. So if you have a fair value, then you can understand whether the current value is overpriced or underpriced, and accordingly you can take advantage of it. That's the basic idea. But again, we need to ask this question: why are we using ML here? And the reason is there are 4 standard models of options pricing that are being used, which are Black-Scholes model, Derman-Kennedy model, and Heston model, and also Cox-Ross-Rubinstein model. So these are the 4 standard models that are being used, but there is a problem with each and every model. So the problem is all these models have limitations, and this performance of these models are the input parameters given to this model and also the assumptions with which these models are built. For example, let's take this particular Black-Scholes model. Since the Black-Scholes model is widely used, let's understand why the Black-Scholes model is limited. So there are certain assumptions for Black-Scholes model. The major one being we assume that the risk-free rate is constant throughout the evolution period, and we will also assume that the volatility of underlying asset is constant. But in practice, that's not true. The volatility of underlying asset would not be constant from the beginning of the contract till the expiry. So does the risk-free rate. And also it assumes that the underlying asset price follows a log normal distribution, which is not always true. And you can only use Black-Scholes model for European style options, and you can't use it for American style options until you make major changes, which would be similar to some other models that are designed for that purpose. So for this reason, there is a limitation for Black-Scholes model. That's the reason you can't exactly price an option. That's why there is a difference between the current market price of an option and the price the Black-Scholes model predict. So for this reason, we say the particular model or all of these 4 models are limited by input parameters and assumptions. So now what is the solution? We can use machine learning. We can use machine learning to price the options contracts and then take certain actions. We are going to discuss what those actions are. So as we discussed earlier, this is the same standard process. You have an input, a model, and the output, and based on the output, you have certain applications. So in this case, so with this particular structure, the features would be implied volatility. As you know, implied volatility is such an important feature that's going to impact the options price. We are going to take similar features that's going to directly impact the options price. We're going to take interest rate again with, let's say, with Black-Scholes model. It will not capture the dynamic nature of interest rate if it is changing, but with ML model you can input the change in interest rates or the updated interest rates, so it will capture the patterns in that as well. And days till expiry, how many days in years the contract is going to expire, underlying returns. So you can also expand this feature set. We are just using these five. We are also adding dividends. So with these, we can use any ML model listed here, lasso regression or decision trees, random forest, and multi-layer perceptron, which is a part of neural network. And you can use any of these models, and it's going to output you the fair price if you design it with that objective. So let's go ahead and see how this is done in Python. So for that, you can navigate to you can navigate to a particular section which deals with it. Let's get to that. Yes, so that is the section ML for options pricing. So I'm going to show you how these four ML models performed. So I'm going to open a notebook called Predicting Options Prices, where all these four models that we have listed here are used to predict the price. And also at the end, we will see how the error is, like which model performed better and at what particular scenario it performed better. So just like any other application with Python, you import the relevant libraries and you import the data. Since we want to, in this particular case, we want to predict call option price. So for that reason, we are importing a data with call option price and also the features we had listed. So with these as data set, we follow the same structure. We will split the data and we will define a model. Here we are using MLP regressor. So just to show you how these things work, and again the same step, you fit the model and you use model.predict to predict. So I will just show you the performance. So when we are using MLP model, this is the performance. I'll explain you how this should be interpreted. And moneyness tells you how far you are from the at the money. If moneyness is 0, you are at the money. If moneyness is negative, you are in the money, and this is out of the money. So as you can see, most of the times the absolute prediction error is close to 0, but there are few instances where there is an error. But this is because we used MLP model. We can also see how the other models are done the same job. So let's see how the option pricing is done with multiple models. So in this notebook, we had created a function which if you just give the name of the model, it's going to create a model for you. So again, the standard steps, you get the data, libraries, etc., split the data. But I'm going to show you the important part, which is a function named model, which takes the training data and also the model name as the input, and the four models we are seeing here. So you can give all these models as model names as an input, and it's going to fit the model on the trained data and give the results for you. And let's see. Let's see how it worked on a single model. So let's try this on lasso. Let's see. Let's create a lasso regression model and see how the prediction error is. So here, as discussed, here we have a function called model, and we also have a function called plot results, which basically uses this output of this function, which is a model, and tries to fit it on test data so that we can see how the prediction error is. So here I'm trying, we have tried it out on lasso. So we gave lasso model name as input to this, and this is output. So as you can see, this is not that great. Comparatively, the previous one is better. MLP is better, but for better representation, we are going to run on all the models, and this is output. So basically, this curve shows you the absolute error with each model across the moneyness. So again, this is just a representation. You can also change the features and change the models, etc., and pick the model which has the least absolute prediction error. For example, If I am working with in the money options, so this model has the least prediction error, which is lasso model, I believe. Okay, this is decision tree. So decision trees has the least absolute prediction error. And if I am working at the money, then the model MLP multi-layer is giving you the least absolute prediction error. But again, these performance of the models will change as you change the data set and would improve as you increase the training set. So this is how you can apply machine learning for options pricing. But why are we doing this? Yeah, we are going to predict a prayer price, but how are we going to use this prediction? So once this fair price is predicted, you can actually identify the mispricing. For example, currently a particular call option is priced at $100, but as per your prediction, the fair price should be 150. So you have found an opportunity there. You can go along in the market, and once it reaches the fair price you had predicted, you can take the profit. And it will also help you to select a suitable strike price if you have an option strategy in mind. And you can also use it for hedging. Let's say you have, let's say, 100 shades of Apple, and depending on the fair price of the particular option contract, you can also see if it is possible for you to hedge, if it is profitable for you to hedge. And you can also use it as your risk analysis tool. So if you are already holding positions in options, you need not wait for the very next day for the market to tell you whether you're making profit or not. You can actually predict the fair price, and if the fair price is below the entry price of yours, you can, or below the current market price, you can take a risk analysis approach, or risk management approach of either keeping a stop loss or completely getting out of the position. So this is the second application. Again, this is widely used by many funds, and this is just a way idea we explained through machine learning, but there may be other complicated ways you can use, or other data sets you can give as input. So let's move to the next application, which is forecast implied volatility. As you guys must know, implied volatility is an important factor in options trading. And for example, the first application is predicting the underlying price, where we are taking a directional position in option. But options has additional advantage to any other asset, which is non-directional trading strategies. So with ML, you can forecast the implied volatility and deploy non-directional option strategies. Now, why do you want to do this again? So the first reason is, by predicting the options volatility, you would know what market is expecting from the particular options contract, and it will also enhance your strategy selection. So if you imagine, you know, the trends of the volume that are developing, or the place where the volume could go, sorry, place where the volatility could go in future, so it will make you to take better decisions, better strategy selection decisions. And you can also manage your position if you're holding a sizable amount of option, and if the option contract, if your ML model says that the volatility is going to crash, you can probably cut down your positions or open other positions that can take advantage of the volatility crash that were predicted. And of course, you can also use it for risk management. Like, let's say if you're betting on increase in volatility, but your prediction says it's going to fall, you can come out of the position or keep a stop loss. So these are the major ways this particular approach is used. And again, just like previous examples, once we realize why, we're going to discuss how. So we are going to give input features, but as you know, volatility is not just a feature of underlying, it's a feature of options as well. Option market input certain volatility, and underlying also input certain volatility. So we have to take features from both of these areas, and we are going to pump it to ML model, and the volatility will be the output. So for example, in this case, especially for underlying, you can use technical indicators again, like RSA, ADX, ATR. And when it comes to option, again, Bollinger Bands, the similar ones we have taken earlier. But when it comes to options related features such as day still expiry and historical implied volatility can be taken as predictive variables, because these are the things that has good predictability for the future volatility. And using these as inputs, you can use any kind of model and predict the volatility. Once the volatility is predicted, you can select the strategy. We can select the strategy that can take advantage of the volatility. So for example, strategies like straddle, triangle, condor, butterfly can be deployed if there is a significant increase or decrease in volatility predicted by the model. So let's go ahead and take an example. In this example, let's take a random forest regressor. And let's define a statement that if the regressor tells that the volatility is going to crash, we're going to short a straddle. So this is the idea. So with these features, we're going to deploy an ML model, especially the random forest regressor. If it predicts that volatility is going to fall, then we are going to deploy a short straddle. So let's again go to the course and see how this is done in Python. So this particular application is covered in this part, forecasting implied volatility. So let me just open how this volatility is forecasted, and following that, I'm going to show you how the forecasted values are traded. Yes. So this is the notebook in which we are going to reach the objective of forecasting the IV. So here we are using a regressor, especially the random forest regressor. So I'm just skipping through the standard steps where you get the data, etc. But the important part is would be the feature identification and creation. As discussed, we are going to use a combination of features from the underlying. Here we are use technical indicators and also the features of the options, which are here we are taking historical IV, like call IV, put IV, day till expiry. So these are all the features we are going to take, we're going to use. And for example, you can use these features, or you can also add other features which you feel might fit to this objective. And once you create a data set with all these features, then you will define the output variable. Now, what are we going to predict? What do you want the output to be? You want the output to be the very next day's volatility. So your target variable would be the next day's volatility. So this is the target variable. So this is on training data. So it's just calculated from the historical data, the very next day volatility. So since you already have a data, historical data, you can use this data to make the model learn and then use it on the test set. To make things simple, there is a function that is created on the name prediction, where a simple random forest regressor is called with basic parameters, and using cross validation, especially the grid search method, the model is built. Once the model is built, you can always call model.predict and pass in the test data so that the predictions will be out. So we created the test data set and used that particular function. So you can actually see the output. The orange one tells you the predicted implied volatility of a call option, and the blue one tells you the real one. So there is a small deviation, but that is expected. We can't exactly or 100% predict the implied volatility. So similarly, we have done it for put options as well. But we don't just stop by predicting the volatilities. As discussed, of the volatility is predicted, if the volatility drops, we are going to deploy a short straddle strategy. So let's go ahead and see how the Python implementation looks like. So yes, so this is the notebook in which we are going to backtest this particular idea and see how the results work. Again, the standard steps I'm skipping, but when you go to important part is where you define your parameters. So here, as you can see, the risk which is the stop loss is 30%, and take profit is 60%. So this shows that if you lose 30%, then you're going to come out of the position. If you make 60% on the capital you used for this particular strategy, then you're going to again exit the position. And if the contract is near expiry, which is 0 days before expiry, again you're going to exit the position. So similar to the previous backtester, this is again the same. So it would be of similar structure. We'll check whether you have a position, and if you don't have a position, then you will check the signal. So if the signal is one, here we used one, you can use anything. Now, we kind of made it easier to understand. If the signal is one, then you need to act on it. That means you need to open a position. Here we're discussing about short straddle. So you're going to open a short straddle position. So setup straddle is a function you can use. So let's see how the output is, and let's see how many trades are generated. And as you can see, there are 29 trades that were generated. And this is again similar implementation. See, for example, on June 12th of 2020, we got an entry signal where you opened a short strategy, you had actually shorted, and you closed your position, means you covered your position on 25th. You held for almost 13 days, and there was a P&L of $116. So similar thing was repeated for all the trades, and by the end, you can actually save the data. And this data can be used to analyze the strategy. For example, here is the analysis of the strategy, where you can see 62% of the trades are winners, and the per trade P&L of winners is more than per trade P&L of losers. That means you, for every trade, you're making more money than you're losing. So at least on this backtest period, this strategy is profitable. But the performance would change as you change the features and also the data set, and also the parameters like stop loss and take profit. So you cannot take this as a advice to deploy the strategy. This is just an example we've shown. So yeah, so this is how the third application goes, and let's go to the next application. The last application, which is predicting the best option strategy to deploy. So this is an interesting case. This actually came out of the research we have done at QuantInsti. We as a team of Contra, we do research certain ideas or applications of ML in different markets and also the assets. So this is the problem statement we came up with, and we created a particular structure to have this objective in mind. So for example, here we are predicting best option strategy to deploy. See, every day there are different kinds of movements in the market, and for example, here first we discussed how we are predicting the underlying and how we are taking a directional position. Then if you want to go for non-directional, we are predicting implied volatility. But even after the prediction, you have n number of option strategy to choose from. But what if you have an ML model that straight away tells you go ahead and deploy this particular strategy? So that's going to be more practical and useful. So that's the reason we conducted this research. So the why is pretty clear to you, but again, there is a strategy dilemma. So as of now, there are almost 25 to 30 most used option strategies, and I must tell you, those are not uncommon. There are common strategies, and there are almost tens of uncommon strategies also. So even if you analyze the market, if you know the volatility and the direction, still you are left with many strategies to choose from. So to avoid this, if there is an ML model that's going to pick a strategy for you, that's going to be very beneficial for an options trader. And second, data-driven insights. So as you must have already experienced, you had already traded. So there is a sea of data you need to understand and then take a call on volatility or the direction, or for the matter of fact, the strategy to deploy. So if you use ML model, then it is very comfortable for you and also efficient for you to inculcate more amount of data and take data driven insights. And the third one is increased efficiency. As you guys know, it is efficient to use automation, especially decision making systems like ML, so that there would be an efficient implementation for your idea. And adaptability again. So the options market is very dynamic. So we as humans, we may not be that adaptive, but if you use ML, then adaptability is the strength of ML, and it can open doors for more ways to generate alpha and make money. So with this in mind, we have generated, or we have structured a process. So I'm going to show you the process now. This is for this particular application. After that, I'm going to point you to the notebooks as well. So as a first step, so as discussed, there are hundreds of strategies. Now, since you're applying ML, we are going to think in terms of ML architecture. So if you had to think what kind of strategies that can be produced, logically, in any kind of options contract, either you buy a contract, sell a contract, or you don't take any position. So these are the only three actions you can take on any options contract. And as you know, any option strategy is a combination of these three. It could be just call, or it could be just put, or it can be a call and put, or a call and put and underlying. For example, if you're hedging, if you have 100 shares of underlying, 100 shares of Apple shares, you might buy a call option, or you might short a call option, or you might buy a put option or short a put option depending on your analysis. So essentially, a trading strategy is a combination of these three contracts. So if you think, if you are taking any of these three actions on these three contracts, then there are 27 combinations. So there are 27 strategies that can be populated by taking these three actions on these three contracts. So since we are defining this as a pure ML concept, we're not taking standard option strategies, but standard option strategies would have already been generated in these combinations. I'm going to show you how the strategies looks like. So this is the output. This is a list of 27 strategies, and let me give you an idea. For example, let's take the seventh one. So you're taking a short of call, you're taking a long input, you're not taking any position in underlying. For example, let's take this last one. You entered a long in call, long input, and also you have a long in underlying. So as you can see, all the combinations that could result to any well-known strategy is covered here. But there is a note, we are only taking positions on at the money options. We are not taking any in the money or out of the money to keep the problem statement simple. Because if you are using in the money or at the money, sorry, in the money or out of the money, there are multiple strike prices. So we are no longer limited to 27. It could actually cross hundreds of combinations. That can also be done, but to give an idea to make people understand the thought process, we have taken a decision to use only at the money options. But before, so this is how you create your strategy universe. Once the strategy universe is created, our ML model will tell you what strategy to deploy. So, but we need to filter these strategies. For example, we want at least one position in options contract. See, for example, see this, see that this one, there are no positions in calls and puts, but we have shorted the underlying. So this is no longer an option strategy. We have only a position in underlying. So these kind of iterations, which are 3, we will remove. So our 27 strategies comes down to 24. And again, we don't want to take similar position in call and put, right? Nobody goes long and at the money call and at the money put, or nobody shorts at the money call and at the money put at the same time while holding a short in underlying. So these kind of scenarios also we will remove. And once we remove, we are left with 20 strategy combinations. So this is a strategy universe. ML model will tell you what strategy to deploy from the strategy universe. So then a very next step would be the same. You will define the features. Since this is covering everything from underlying and options. We are going to take features of underlying, features of options and options Greeks as well. And we ML model going to predict the strategy to deploy. So I'm going to show you a list of features. These are the features that covers underlying options and also the option Greeks. So here we have used 5 option Greeks, and we are going to use an LSTM model, which is long short-term memory, a neural network model for this, and it's going to tell you what strategy to deploy. So especially we have used this structure, but you guys can use any LSTM architecture. You can change the architecture. For example, we have a 1 input layer with 5 hidden layers. You can also play with different number of hidden layers, and we have 1 output layer. And these are the specificities, the activation functions that are used for these layers, and the optimizer with the learning rate. But these things can be changed and see how the model reacts. And we trained this particular model. So what do you mean by training? When we say training, the model is using these features and learning which strategy was most profitable. For example, on a particular day in the history, out of these 20 strategies, if 15 is the strategy, it will learn the internal pattern so that it can output strategy 15. So with that in mind, we are training the LSTM model from 2010 till third quarter of 2020. It's a sizable amount of data. And again, we are deploying or testing the particular LSTM model's performance in these particular years, like third quarter of 2022, third quarter of 2022. And this is the output, and this is how the performance was. And in the testing period, initially the model did not perform that great. It was giving profit and again coming to break even, etc. But during COVID, it would have performed a bit different. You guys can test that. Test it as well. But as we move forward, the performance had improved, and even though the market is falling, this is underlying the market is falling and underperforming, the model picked up and started to make money. And you guys can also check the implementation in this section. So there are several sections actually that's covering this implementation. There are 4 sections to be exact. And in this particular section, it's going to tell you how to create the output variable, like how to create your strategy universe. And then the next section tells you how to create the input features, and then you can create the model and backtest it. I'm going to show you one notebook probably. Let's see the model thing because that is very important, and that's the objective. Again, we want to pick a model that's going to tell you what strategy to deploy. So let's go to this notebook quickly and see how the model is designed. So after we import the required data, etc., and these are all the list of features as discussed. There are quite a few features because we are taking features from underlying options and also the option tweaks like delta, gamma, beta, theta, rho. So with this in mind, we have created a model. Okay, this is a model. So as discussed, there is one input model, five hidden layers, and sorry, one input layer, five hidden layers, and one output layer. And once everything is defined, this is how the model looks. So this is the architecture of the LSTM model with the details of the dense layers used as hidden layers. And yes, so this is where we are trying the model. So you guys can go through this notebook for in deeper analysis of how these things are done. And at the end, you have a section where you have a notebook where the strategy is analyzed. And yeah, I will show you this as well so that you would know how this result is shown. Yes, so this is a notebook where the particular trading signals were analyzed. For example, I'm going to show you the output. So this is the output we had seen earlier. This is the output of a model that is telling you what strategy to deploy for you, and you're actually testing how it had performed in the history. And there are lots of analysis you could do in Python. You can generate heat maps and understand how the monthly performance was, and also you can also see certain metrics like maximum drawdown, like what was the maximum loss here. The maximum loss was almost close to 35%, but you can control this maximum loss with your stop loss. And what was CAGR, and what was the annual volatility. As you can see, the volatility is very less, which is good. It's always better to have a strategy with less volatility. So yeah, this is how Python is used for this particular application, which is making an ML model that's going to tell you what strategy to deploy the next day. And so let's go ahead to the last part, which is additional applications of ML in options trading. So far, we have discussed how options data is used for as an input to ML model for these four applications. But in addition to options data or replacing options data, you can use a sentiment data. Now, what is sentiment data? Sentiment data, first of all, sentiment data can be generated or can be collected from various data providers, but in general, it will be generated using natural language processing NLP. So NLP especially extracts the information from text data, which can be converted into sentiment data. So to give you more clarity, this is the data used, social media data, like for example, whether people are tweeting positively or negatively about a particular stock you're holding, and financial news articles on that very asset, and market research reports which talks about the future performance of the particular sector of the stock, and earning calls, corporate disclosures, etc. So all this information, it's very difficult for us to go through all this information and come up with particular idea on a market and take option strategies. So you can use ML to extract information from these and then generate sentiment data and use as input to your ML model. And so far we have used single markets options data. You can also use multiple options market data. You can create a portfolio of options and then use ML model to tell you the best combination of options through these markets to give you better profit. And we have seen examples of these list of ML models, but you're not limited to any list we provided. You can also use as complex as reinforcement learning model. As some of you guys know, reinforcement learning model can be used to optimize a trading strategy. Basically, it has agents that takes trades and learns as they are gaining or losing. So basically, it learns from past trades and the rewards you decide. And you can also use it for options pricing. Again, this used to be in research phase, but yeah, there are pretty big funds that are using reinforcement learning for predicting or calculating the fair price of an option and having strategies. And you can also automate a hedging. Basically, you can create a reinforcement learning agent that learns how to hedge properly, and then you can automate it. So yeah, these are a few advanced or additional applications. So as discussed, this is the last part of this webinar, and we can move ahead with Q&A. And over to you, Sidis.
Thank you for this wonderful lecture, and I will request everyone to now post their questions. Meanwhile, I would like to also share about the Quantum Summer Sale. So, starting today, we are offering a minimum of 75% discount on all Contra courses, and all the webinar attendees can enroll in this courses with additional benefits. So for the next 4 hours, attendees of this webinar can avail flat 77% off on any contra course by using coupon code WEB77, and flat 85% off on all contra courses by using coupon code WEBALL85. I have also shared the link in the chat, so you may want to explore that. Uh, yeah. So we have received a lot of questions, but we have crossed the 1 hour mark. But still, I mean, we can take 5 minutes and answer some of the questions. And so I have flagged the questions. So if you can see, the first question, interesting one that I have flagged is by Lucas. Now, Lucas is asking, what is an acceptable accuracy range to affirm that the model is able to predict prices or trends?
Yes, so thanks for the question, Lucas. Uh, Acceptable range, there is no standard acceptable range, but one observation is it's very difficult to gain accuracies as high as 80-90%. If your model is doing that, that's pretty good. And but yeah, you don't want to trust a model that has less than 50% accuracy because it comes under randomness. So if you have a model that has probably above 60, 65, then that's a pretty good model. But again, that shouldn't be a decision making factor for you, because not just the accuracy of the prediction, but it's also what strategy you're deploying based on those predictions and how the performance of the strategy is. So you can also gain money with a model that is not giving you 90% accuracy. So you can keep that in mind. Thank you. So
Okay.
let's go. Yeah, I have an interesting question to pick from here, which was from Jacob. The question is, have you tried to use option chain as input to predict underlying, knowing that the market needs to adjust delta as price moves? So that's an interesting observation, Jacob. And yes, yeah, there is a part of research that was done on this. You can also try, as you rightly mentioned, we have shown you features which are quite basic. If you want to use option chain, you can also use option chain features, especially the you can go as deep as the bid and ask values of particular strike price. You can also calculate option Greeks based on option chains and give them as input, and see how, especially the open interest of particular option contract has a bit of a predictability, or change in open interest has a bit of a predictability on the direction of the market. So yes, you can use this. Okay, there was a question by Richard. Richard says, why don't you use any feature detection? Actually, feature detection was used as a part of this, and yeah, that's a very good measure to decrease your feature space and improve the efficiency of the model you are using. It has less stress on the resources you're using, and would also be useful if you decrease the features that are not contributing to your accuracy of the model. Yes, so feature detection is used. Let me go to the next interesting question. Um, so how often should we retrain the model? Yes, Lucas. So generally, when you create an ML model, you save the model externally and you try to uh, carefully observe the performance of the model. And you would have a threshold whenever the accuracy of model drops below a certain threshold, or whenever the performance of the strategy drops below a certain particular threshold, you can stop using that model and retraining on the new data. Hope I've answered your question. A question by Sanjay. Is there any reason we are not using any scalar like min-max scalar or standard scalar? Yeah, Sanjay. Min-max scalar and standard scalars are used, of course, depending on the data also, but most of the cases these are used, and it is recommended to scale your features, scale your input data before you move ahead with your model fitting. And so the next question is gentle. Question is, how would be the accuracy of these applications considering the target for 5 days or 10 days or 30 days. So as we move away from the expiry date or the prediction date, we are going to do as the number of days of forecast increase, the accuracy would be low. So that's the reason in few cases we used the prediction for the next day, and in few cases we are used for 3 days period, not more than that. But you can also try different periods with different set of features and see how the model is performing. And Mr. Gentil had one more question. For the application of trend prediction, what are the best features which improve the accuracy of the model? So actually the answer lies in the question itself, because you want to predict the trend. So you would want to ask a question like what defines a trend and what causes a trend. So in general, trend is caused by psychological behavior where basically if there is an uptick of a stock with enough volume for a number of days, people are going to flock to the stock and continue the trend. And also if yeah, that's one factor. And also as we discussed, sentiment analysis also could be done and taken as a feature, like the social media reports or market reports or the reports released by the company itself on their performance, etc. These are the things that's going to start a trend other than the economic or global macro trends. If you stick to these particular contracts, then these are the straightforward features you can use for trend prediction. And it would definitely improve the accuracy of the model as you keep on exploring these features. So the next question by George is it useful as a program taking a position in arbitrage between closing and opening of relative markets? Uh, when you ask me if it is useful, yeah, as a trader, you would want as n number of trading strategies for you to probably mine that alpha. So yeah, it's always useful for you to create certain programs that takes different actions, be it arbitrage, be it hedging, be it right away directional trades, and see where the alpha is, and you can probably combine them or take a single option trading strategy as your alpha generating machine. And so the next question is by Samar. The question is how much data required for these ML option strategies. So yeah, that's again a good question. So the data, if you have sizable amount of data, let's say 10 years, that is good. You can train on, if you can train on 10 years of data and then test it on, let's say 3 years of data, that is decent. Because in data analysis, especially in ML, if you have more amount of data, then you have good fit of the model and good confidence of the model. But as in financial markets are limited by the data, we don't have 100 years of data or 200 years of data. So as much of data you can gather. If it is more than 10 years, that is good and decent. And if you can get more data than that, that is great. Hope I've answered your question. The next question is by Saha. How do we choose the ideal duration for the time frame to backtest a model? Again, the more data set, the more historical period you backtested, you give the model or you give the particular algorithm chances to expose to different market scenarios and market cycles. So if you have more data, you have a strategy that was tested on more data, then you can kind of confidently say that yeah, your strategy had already experienced different markets or economic cycles. So yeah, so I would say a time frame duration, yeah, in terms of historical data, if you have tested it for a decade or two, it would be great. And when it comes to frequency, like should you use a daily data, hourly data, or minute data, it completely depends on your strategy. If you want to trade, then you pick a higher frequency. If you want to invest and also probably swing trade, you would pick a medium and long-term frequency. And yeah, that's a good question, Saha.
Varun, sorry, we are running out of time and we still have questions coming in. So we will pick one last questions. So I can see there are certain interesting questions, but this recent question asked by Adam, I think. So why don't you use Hurst exponent or other quantitative trend indicator to select market regime with trading strategy?
Yes, thanks for picking this interesting question, Sidis. And also thank you, Adam, for this question. Yes. So Mr. Adam is asking, why are we not using Hurst exponent or any other quantitative trend indicators? Of course, you can use Adam, and you're not limited by the particular model or any kind of theory. You can use all these indicators, be it Hurst exponent, be it any kind of trend indicators that were defined quantitatively, which actually tells you the regime. So you can define regime in multiple ways. You can have a volatility indicator, quantitative volatility indicator that defines a market regime. You can also have a trend-based indicator, or you can also have combination of both. So you can customize your own indicators that are going to divide the market regime and give it as an input to your model as a feature. So if you have 5 regimes, you can directly hot and code those features and give as input. And it's going to really improve the accuracy if you are using market regime, because not many indicators captures the market regime. And thanks for asking that question, Mr. Adams, and I hope I've answered your question.
Yeah. Thank you so much, Varun, for asking all of these questions. And for to our audience, in case your questions went unanswered due to limited time we have had, we would love to connect and address all of your questions individually. So please share your questions and availability after this webinar ends in the survey form, and also share the topics you want to cover in our upcoming webinars. So please share this valuable feedback with us after this webinar. It will help us, it will motivate us. And yeah, again, thank you so much, Varun, for taking out your valuable time and conducting such a wonderful session again here with us, and explaining all the applications of machine learnings, and answering all of these interesting questions. With that said, I would say thank you to everyone, and have a great day ahead. And yeah, thank you all for your time, and I look forward to our next session. Thank you.
Yes. Thanks, everyone. Happy learning.